So it is my honor to introduce our first presenter of the morning, which is Jordan Levine. He's coming in virtually. So here he is. He serves as the Vice President and Chief Economist of C.A.R.
I'm sorry I couldn't be there in person, but I hope you guys at least get some value out of this. I think the big picture as we kind of transition from pandemic to endemic is, there's really two forces going on there. On the one hand, when we think about the housing market in general, we see a lot of signs that the market's starting to normalize, and we can see that across a variety of dimensions, whether it's where people are buying, what people are buying, where that demand is starting to come back. The markets that are leading the growth suggest that we're starting to look a little bit more like we did before the pandemic than we did during the summer of 2020. And yet, even as that is very much the case, I think the lasting legacy of this pandemic is that it has really just exacerbated our pre-existing conditions. A lot of those structural changes that were already underway for the last decade leading into this crisis are I think, even more acute now than ever before. We've got a renewed passion for home ownership amongst consumers. We've got remote work and a lot more flexibility that hopefully will be an opportunity for us to right size kind of where the people and the housing are and things like that. But it does make it incumbent on us to start to address the major structural challenges, which is why I so appreciate the opportunity from Ryan and the association to be able to be here speaking with you today. When you kind of zoom out from just the kind of pandemic-driven dynamics, I think there's a lot to be optimistic about. Even with this current flare in the public health crisis, the economy continues to improve nonetheless. In fact, the national number that we just got for December, and we don't have California yet, it's almost down to pre-pandemic lows. And so, we're not necessarily firing on every cylinder, but we're seeing broad-based growth across the spectrum of geographies, industries, et cetera. And I think housing in particular will kind of remain on the leading edge of that recovery, again, notwithstanding the public health numbers. I'd be lying to you if I said there wasn't some headwinds out there that we're monitoring very closely. But to me, the biggest challenge that we have isn't all of the kind of what happens as a result of this crisis, but really how do we find the housing supply to generate more home ownership, to maintain or improve housing affordability, and to keep the market moving, because we're really in dire straits in terms of housing supply, both new and existing. And on top of that, we are going to layer in some of those macro challenges as well. Higher rates, which means less housing affordability. We are seeing prices grow at an incredible rate, which raises questions about sustainability. And so I think that, on the one hand, housing's in a good spot, right? Consumers need us more than ever. But I think it also means that we've got to really work harder than ever as real estate professionals, as policymakers, as a state, together to make sure that we can kind of keep California at the leading edge of the economy and certainly have a vibrant housing market. Let's talk about the economy real quick, because I do think that sets the stage for the housing specific issues that we talk about, whether it's fire insurance, ADU, housing supply, what have you. And let's get the bad news out of the way early, right? This is the new cases on COVID. And for 2 years in a row now, I've had to make my forecast when we were in a valley for the new case numbers. And that really does challenge things. That happened again this year. You can see this October, the numbers were coming down at a fairly decent clip. And then about 2 weeks after I gave the forecast, the numbers spiked. I think this doesn't change our outlook for the forecast necessarily. It's kind of a wash. On the one hand, I think that we'll have less economic growth maybe than what we originally forecast back in October, but we'll also probably not see rates go up quite as quickly as we forecast about 5 months ago either. And so from the standpoint of the forecast, that's still on point. But the one thing that we've seen pretty consistently is that when the public health numbers deteriorate, this is one unique crisis where it's actually reinvigorated the housing market, right? Usually a bad economy leads to a bad housing market. But in this specific case, the nature of the crisis, again, made housing more important to folks than ever before. And we've seen that continuously. So there's a chance this might drive even more folks into housing than what we originally forecast as the crisis kind of lingers. On top of that, we've got an economic recovery that's well underway. You can see back last year, we lost almost 3 million jobs. through the end of November, we had already added back 1.9 million of those jobs. Most of the jobs were lost in these high contact, low wage, face-to-face businesses. High income earners have really been fairly insulated from the effects of the crisis, and in some way are even better than ever, which really helps to kind of exacerbate that housing demand, on top of the fact that just the economy in general has been well on its way to full recovery for the better part of the last 2 years. Even as the COVID numbers have gone up and down, the jobs numbers have been a fairly consistent uptrend. You can see here how those job losses were divided out across the state. San Diego wasn't the hardest hit area in the state, like the resort heavy markets where a huge chunk of their economy is hotels, restaurants, et cetera. We have a lot of tourism related jobs in San Diego, but we also have a lot of biotech, high tech, your Qualcomms, defense contractors, et cetera. When you look at where we stack up on the road to recovery, San Diego is actually right on top of the statewide average. We're about 2/3 of the way towards that pre-crisis level of jobs. And again, moving in that direction on a pretty consistent basis. So the economy is a tailwind, I think, for housing now, because it's moving in the right direction, and the nature of this crisis was already feeding housing demand. So that's the kind of good news. And we're just working on finalizing the December numbers now, but it looks like when the dust settles, that 2021 will be the best year for home sales in a decade, slightly edging out 2012. And that's pretty remarkable when you think about just the kind of herky-jerky nature of the broader macro economy. And again, I think this is a testament to just that renewed passion for home ownership, that value of home, where our homes are now more important to us than ever before. We do see signs that the market's normalizing. I'm showing you here sales growth by price segment, and you can see the top end of the market, 2 million and above, which has been outperforming the rest of the housing market. It's still outperforming. We're talking about 30-40% growth over the course of the last couple of months, not 300% growth. That's one sign of normalization. You see it if you look at square footage, which went from 1,750 square feet before the crisis to about 1,850 square feet. That's starting to normalize down as well. You also see the condo market starting to come back, but mostly where you see it is in the geographic distribution, right? And after Tahoe and Big Bear and Lake Arrowhead and all those places had really phenomenal growth in 2020, growth returned to the core in 2021. And you can see that Southern California is the second fastest growing region. A lot of that growth in coastal Southern California, LA, Orange County, San Diego, not everybody moving out to the inland empire. So a lot of signs that we shouldn't give up on our cities. I'm, being from San Diego originally, I know that it has a lot to offer, and I think you could see that borne out by the statistics. But when you look at the forecast, we're not expecting us to be able to maintain that 15-year high. And it's because we don't have enough homes to put these buyers into. I just checked the MLS last night, and we have about 15,000 units on the market across all MLSs statewide. That creates, challenges for being able to maintain a 510,000 unit pace for home sales. It's not for a lack of buyers. Buyers want to buy more than ever, but we just can't generate or sustain at least that level of transactions that we started with last year, because we, again, don't have the homes to put these buyers into. You can see that the COVID flare is impacting the amount of homes that we're putting onto the market. Usually we have a big chasm around Christmas, and then listings start to bounce back. We start to put more on fairly quickly in the first couple of weeks of the year. And you can see that we've had a more tepid response there. And that leads to the kind of levels of market competitiveness that you see out there today, where 60% of homes are closing above ask, where, the median home went pending in less than 2 weeks. That's up a little bit, but it's leading to these kind of price levels that are still growing by double digits. Even in the middle of winter, we're still hovering at around an $800,000 median price point, which again speaks to the strength of housing demand without the supply there. And what's really going on, right? Part of it is demand, right? And you can see in our consumer survey that more buyers bought sooner as a result of this crisis. They not only were in the market, they went out and bought faster than they were originally going to, and ended up actually buying different products, bigger homes, single family homes, homes with more outdoor space. But really those prices are a result of the supply side, right? Because if you just take a zoomed out perspective on California, we've gone from 25 to 40 million people. The number of realtors has doubled, more than doubled actually by now over the course of the last couple of decades. And yet we build about a third as much as we used to in the mid 1980s. And that's why even in a market with white hot buyer demand, we really can't generate any more housing transactions than we used to. And there was 15 million or so people fewer in the state. And it's not just a function of cherry picking out a specific year, right? You can see that only 5 times in the last 33 or 35 years have we ever gotten above the state's estimate of how much we need to build just to be able to tread water on housing affordability. San Diego County, if I took the numbers off the axis here, you'd be hard pressed to distinguish this from the chart I just showed you at the statewide level, right? We actually build a lot less than we used to in the 1980s. We've gone from 2.3 to 3.3 million people, added about 500 or so thousand jobs on top of that. And again, we build about a third or so as much as we used to. Thinking about ADUs have increased over the course of the last couple of years as a San Diego data specifically. But you're talking about a relatively small number. If we used to permit 30,000 units a year back in the 80s in San Diego, you're talking about 1,000 out of 30,000 permits. It's about 9% of what we're building over the course of the last couple of years, but still pretty small numbers, right? When you look at where they're built, I just read an article yesterday that said all the high cost areas are the ones building all of the ADUs, but you can see it's actually pretty evenly distributed across price points if you look at the chart on the right hand side. But there's a lot of consequences to the lack of supply. We had housing affordability already going down, even with 2.6% rates. We have a big gap in home ownership with the rest of the United States, particularly in those demographics that are going to be especially critical for home ownership and California's economy moving forward. We have a lot of folks that are choosing to leave the state. We had population that declined for the first time in recorded history. And that's, again, before we talked about the impact of rates and more inflation that are going to be the kind of double whammy when it comes to housing affordability next year. You can see that even small changes in rates here have a big impact on monthly mortgage payments. And that's why it's incumbent on us to get really serious about the supply issues. We think that, the cycle is going to continue to move forward. In fact, we're maintaining about 10% more sales now than we had even before the pandemic, but you can see that sales are suffering from this lack of inventory, and they've been on a fairly consistent downtrend from the 15-year highs that we had at the end of 2020. When you think about the economy, we're optimistic. California is going to actually outperform the rest of the United States, but again, we're not going to be able to maintain those 15-year highs for transactions. And it's because we have too many buyers. Prices are going to keep going up at the cost of housing affordability, which is why hopefully this generates some good conversations about how we get that pipeline of supply going. There's a lot of good news out there, whether it's the economy, buyer demand, the fact that the market for sellers is still good and that prices are not poised for a big decline, despite what your brother-in-law told you. The bad news is that our kind of supply chickens are coming home to roost on us, if you will, and that's impacting our ability to fulfill the American dream for our residents. We're putting those first-time buyers up against it, and really, I think it kind of underscores the need, not just for all of our eggs in one basket on ADUs, but for an all of the above solution, so that we can get all of those boats rising in this broadly rising tide. So again, thank you so much to Ryan and the team for having me here, and I appreciate all your time. And go Padres.
Thank you very much. It's wonderful to hear that presentation, and thank you for making it specific to San Diego as well. We appreciate all your expertise on this. Really do. Thank you. Again, is Jordan, and he's from C.A.R. He's our economist. Let's give him a hand.